I just would love to kick off by just recalling that I just can't believe it. The Atlanta Fed is talking about 4.2% growth, and Trump is talking about 5%, 6%. These numbers to me are completely insane, and perhaps I'm not too surprised that volatility erupted in the beginning of February. Perhaps the market is trying to tell us something. And I wonder, perhaps, Dave, whether you might try and tell us something about what all this might mean.
Yeah, well, the thing about it is volatility has been dead as a doorknob for the last few years. At the beginning, that's at the end of last year, the beginning of this year, we had single-digit volatility. So we use a measure called the VIX, which probably most people heard of, the fear gauge, which is the underlying daily turbulence of the S&P 500. And when you get to single-digit numbers, you know there's something up.
It's too good to be true.
Yeah, usually it ranges somewhere like between 15 to 20. That's roughly what it is. It's a kind of slightly abstract number, and it's built upon how they calculate the index. Anyway, so we got down to about 8 or 9. And the last time we got down to 8 or 9 was 2007, which I think tells you everything you need to know. So it was always a bit unduly calm, and therefore one shouldn't be terribly surprised that there was an outbreak of volatility. It's very expected. And I saw a fund manager who's quoting a chart from Longview Economics, who do a lot of this kind of stuff.
Oh, yeah.
And what they did is they did a composite of a bunch of asset classes, not just equities, a load of stuff. And even after the recent bump up in volatility, we're only close to the average for the last 10, 20 years. So
we're falling again, aren't we?
Yeah, absolutely. Before we're falling back down again now. We're still sort of in a long-term range.
Yeah.
So we shouldn't be terribly surprised by any of it. Yeah. And in fact, there were too many people who were short the VIX. So in America, you can trade volatility via trackers, not strictly in the sense SLL's short leverage trackers, they're more just tracking volatility. And there were lots of people who were buying them thinking they go short. And that was a really good trade until it wasn't. And then it catastrophically blew up. And
but it wasn't just people, it was institutions as well.
Institutions, yeah. I think one big investment bank had to suspend its tracker on volatility going down because it all blew up. So we shouldn't be surprised by that. The other thing, but the more relevant story and less cynical story is that what's really going on, I think the prime driver here is actually going on in the bond markets. And there's a very close relationship, not watertight, but there is a close relationship between the yield on long-dated US Treasury bonds, called 10-year Treasuries, and the equity markets. And by and large, when that long-term 10-year Treasury yield goes above 3%, and certainly 3.5%, people start getting frightened.
Because that's effectively a forecast to where interest rates are going to be.
It's effectively used as a gauge for both inflation as well, which I should mention. Yeah. People, they basically think you're going to jack up interest rates, which in turn are going to jack up bond yields. And the symbolic marker point is about 3%. Yeah. And I can't remember where we are, but I think we're probably about 2.8, 2.5, depending on the day.
Yeah, I've seen a number like that.
So depending on the day you're at, it's roughly running about 2.85%. So it's not very far away.
Yeah.
Now the problem you have to bear in mind is it has been above 4%, 3.5% in the last 4 or 5 years. I think in 2014 it went above.
Yeah.
It's about 4%.
Yeah, but that was briefly.
Briefly, exactly.
That's the point. This is sustained.
This is sustained. And what this is telling you, the reason why that 3% and then the 3.5% is so important for equity market volatility, and actually for a load of asset prices, is that once we get above 3, once we get to 3.5, you should expect much bigger increases in volatility, much more bigger amplitude of daily moves. Yeah. And that's not just for equities. That could be for bonds. It could be for commodities. Yeah. And knock-on effects on the dollar, which we'll talk a bit about later. So the big story here is, I think, what's happening in the Treasury bond market and how that's impacting equities.
Yeah, it's a kind of feedback mechanism.
It's a feedback mechanism.
Because people are now changing their position because they think things are going to be hard to foresee, as opposed to everything's so easy.
Well, very interesting. Gold, for instance, which is a classic hedge, and gold really tends to trade in a range between about 11.50 and about 13.50. And it hasn't really. It's at the top end of that range. It hasn't really broken out of that. And what that's sort of telling you is that people aren't terrified, because if they were terrified there's going to be a massive economic slump, they'd all move into gold. But if bond yields start going to 3.5%, what that tells you is actually I could just sit in bonds, nice, safe, boring bonds, equivalent to cash.
Even my bank deposit account might start.
And I could get myself 3% a year.
Yeah.
You know what? That's better than losing 5 or 10% in equities. Yeah. So that's a lot of the calculation that's going through people's minds.
Better than gold.
Absolutely, a lot better than gold. We get no yield at all. So, there's one bit of this is, as you said, about expectations about where the American economy is going. I don't believe those estimates saying 5-6%. And if it is, we'll have an enormous...
You just believe the Atlanta Fed?
Yeah, I just believe the Atlanta Fed. Because if we did, there'd be an enormous blowout and their interest rates will go for 5-6% and we'll have a great recession again.
Look, Trump's the only one that's talked about 5 and 6.
I was about to
of course,
say,
we don't quite believe Trump.
Everything he says. Sometimes he do. If trade wars, particularly, I suspect he might try and have a go at it. But I think not all. And it's not all under his control anyway. Let's be honest. The American economy is not singularly under the control of President Trump. There are lots of other factors going on there.
Yeah, that's fair.
So I don't believe that. So I think we are probably what we call late business cycle. Yeah. So we're late in the cycle. It's been a recovery for a few years.
Yeah.
That tends to indicate more turbulence, more volatility, more kind of dispersion, where lots of different investments move in different ways.
Yeah.
And it's a slightly bumpier market where, you're not just going to sit tight, stay in S&P 500, for instance, just for a few years and you do well.
Yeah.
It's not that kind of market. I think you've got to be more careful about what you pick now.
Yeah. It's for being selective on your ETPs or being selective if you're an active manager.
Absolutely. It's absolutely the same. And there's no guarantee, for instance, now that equities and bonds will move in the same way as gold will move and commodities will move and the dollar will move. They might all move in different ways. And I think the big story of the last few years is, by and large, everything has been moving roughly in the same way.
It's all been synchronised.
It's all been synchronised. And what we're now happening is there's that desynchronisation where things move differently from each other.
Yeah.
So equities might move one way, you might see the dollar move another way.
Yeah.
And that opens up both risks
Yeah.
and opportunities.
If you know what you're doing.
Yeah,
That's right.
exactly.
Yeah. So where do you think the trade wars, inverted commas, are going to end up?